the best of Money Matters.
Market View on Money FM 89.3.
That's right, you're tuning into Money FM 89.3. Time now for Market View with me, Chua Tian Tian, where we take you through how the Singapore stock market closed for the day, the biggest movers, sectors, and of course the companies to watch. But as always, a quick recap of how we started. Well, Singapore shares were higher today as investors continue to digest global developments ranging from US President Donald Trump's address to Congress to China's latest GDP growth target of around 5% for 2025. Now, as at about 2:20 p.m., the Straits Times Index was up 0.29% at 3,901 points, with a value turnover of 754.86 million Sing dollars in the broader market. Now let's take you through the closing numbers. Well, we saw the gains easing towards the end of the trading day. The STI up 0.2% at the close at 3,898 points. In terms of value turnover, we are looking at 1.43 billion Sing dollars. Now gainers outnumbered losers 338 versus 205. Top advances for today, we've got your City Developments, PC Partner and Semco Industries. And top decliners, we've got Jardine Cycle and Carriage, iFast and Venture Core. And in terms of companies to watch, we have for you the local bourse, the SGX, because the bourse operator launched its second batch of Hong Kong Singapore Depository Receipts, SDRs, today in partnership with Phillip Securities. Now, elsewhere from China, maintaining its 2025 GDP growth target at about 5% for the third consecutive year. To what to watch out of US President Donald Trump's address to Congress, we've got more international headlines in focus. And joining me on the line today is Kelvin Wong, Senior Analyst at OANDA. Kelvin, welcome.
Yeah, thank you for the invitation again, Tian Tian, and good afternoon.
Great to have you join us. And Kelvin, lots to talk about in global markets, but let's try to tackle things one at a time, starting with the Singapore stock market. How did the STI fare today? Any surprises when it comes down to the biggest movers and also the sectors that they lie in?
Well, I would say that it's more related to a positive spillover, especially up from the Chinese parliamentary outcome, with Premier Li announcing the latest report book for 2025 in terms of the strategy to actually grow Chinese economy. So market kind of reacted positively from the Hong Kong indices. We can discuss more about that later. And it has a positive spillover impact to the rest of Asia as well, benefiting the local STI. So what I could see from a technical point of view, definitely is positive, because if you look at the last three sessions, we actually tested the rising 20-day moving average, and today it managed to have a positive close at the 20-day moving average, a bit more of a kind of softer pace of appreciation rather than a very strong rebound. So what you could see over here is that I do believe that market participant in the longer term view still is a bit hesitant to be outright bullish because of this ongoing U.S. Trade tariffs against the rest of the world.
Okay. Now let's zoom in on some of the companies to watch on the Singapore Exchange first. We've got the bourse operator itself, SGX. It launched the second batch of Hong Kong Singapore Depository Receipts, SDRs, today in partnership with Phillip Securities. Broadly speaking, what will this mean for investors? How far will it boost activity on the SGX?
I think it's a rather smart move from our local exchange. The Singapore Exchange was very timely right now as well. So if you look at the recent year-to-date performance of the global benchmark stock indices, definitely the Hang Seng benchmark indices, which represent the Hong Kong stock market, is one of the outperformer against the rest of the world, especially Hang Seng Tech Index that is concentrated on the China Big Tech, where we have actually one of the new Hong Kong SDR, which is Meituan, to be actually listed on the Singapore Exchange. So it's pretty much timely for local traders to actually take advantage of this ongoing bullish momentum that's been seen on the Hong Kong stock market in the last 3 months or 2.5 months or so. And also, don't forget over here is that one of the benefits of trading this SDR listed on the Singapore Exchange is, in terms of price, is less costly compared to trading directly from the Hong Kong stock market.
Okay. Now, another counter to watch for today, Kelvin, and we've been watching this counter for quite some time, the past week already, and that is City Developments Limited. Now, the latest development here is that Dr. Catherine Wu, who is said to have a long relationship with CDL Executive Chairman Kwek Ling Beng, has resigned from her role as an unpaid independent advisor to the board of Millennium and Copthorne Hotels, or MNC. Now, MNC being a subsidiary of CDL. I know you don't comment on individual firms, but speaking in generalities, how big of a damage can corporate governance issues cause to firms, and how long-lasting can they be even after, efforts to rectify them?
Yeah, for sure. Because if you look at the initial reaction from CDL share price after this, we call it this hoo-ha has been we call it the lack of proper corporate governance has taken shape. I mean, there was actually a negative price reaction of, I think, close to negative 7% for CDL share price before recovering in the last day or two or so. And given the fact that it seems to us that with the removal of the advisor, the special advisor of CDL board, markets participants seems to be rejoicing to it, to the share price of, based on the share price of CDL today, where it's actually the second biggest outperformer on the STI, up by close to about 2.8%. For today. So for sure, definitely, if we start to see lingering corporate governance that is yet to be addressed, market participants will view it as nepotism and lack of check and balance in a particular listed company. And in the long term, that doesn't actually gel well to create a positive shareholder value. And that could be punished by a significant drop in the share price, like what CDL witnessed in the last week.
I see. Now, if you're just tuning in, when I'm in conversation with Kelvin Wong, Senior Analyst at OANDA. Well, across the region, Kelvin, all eyes are on China after Premier Li Qiang announced this morning that China maintained its 2025 GDP growth target at about 5% for the third consecutive year, despite U.S. tariffs. Now, Li also delivered the government's annual work report at the opening of the third session of the 14th National People's Congress. Now, I believe Hong Kong and Shanghai equities largely positive on the news, but really, how would you read into the latest numbers, particularly the top-line numbers?
Yeah, so if you look at the top-line numbers, it's more or less came in within expectation, especially we're talking about how to achieve 2025 GDP growth target for China at around 5%, maintaining the same level, despite the fact that the external environment may not be so rosy for China this time around because of the ongoing trade tariffs that U.S. White House that may likely impose on China and the rest of the world. But on top of that, what China did over here is that they actually increased the budget deficit to actually 4% of GDP. So that's the highest budget deficit seen in most of the decades or 10 years or so. So that actually implied that in order to achieve this 5% growth target as desired by China top policymakers, China need to have much more fiscal stimulus measures to achieve that. And one particular big hint that comes out will be the work report that Premier actually announced during the morning session in today's MPC, was that the word consumption or boosting of consumption was mentioned 27 times.
Wow.
So based on the record, this has been the most in almost a decade.
Okay.
And previously there was this pet phrase of high quality development, so that's representing high-tech manufacturing sector. That was the favorite, that was the top hot word was used in previous year report, which was last year. So last year, this particular verb, high quality development or phrase, has been mentioned 25 times, but today it was actually dropped to only 7 times. So if you look at this change of tonality in the report, the China top policymakers now pretty much concerned about this lingering deflationary risk spiral that is taking shape in the Chinese economy, even though they kind of use the word deflation. But from what is implied in this report over here is that the top priority is to actually negate this deflationary risk spiral. But how they're going to do that? They're going to actually boost consumer confidence. So that's why consumption is being mentioned 27 times this time now. So market actually read that as a rather positive sign, at least in the short to medium term, to actually start to see this kind of positive fiscal stimulus or much more forceful fiscal stimulus that's going to be rolled out in the months to come. And that lead to this risk-on scenario that we see on the Hang Seng stock in the first today.
Okay. And, Kelvin, what else should we take note of out of China's two sessions, especially against the backdrop of heightened volatilities? I mean, if we look at the timing of the two sessions, come just as U.S. President Donald Trump doubled the rate of tariffs on Chinese imports to 20% yesterday. We know China has responded by imposing tariffs of up to 15% on U.S. farm goods such as chicken and pork from the 10th of March. But really, how far do maybe the language mentioned and the work report, as you talked about earlier, and the directions that set out help position China for an uncertain global trade environment?
I think what we're going to see over here is that we're going to see how other major players react to this particular trade war 2.0 that will play out. So indirectly, China also benefited from a weak dollar that was started to see in the last 1 or 2 weeks or so. So what we could see over here is that it's very coincidence over here is that, yes, despite the fact that Donald Trump actually introduced this rather hawkish trade tariff policy, not against China, but against other major trading partners, Canada, Mexico, and even potentially EU down the road, that you mentioned as well. What you could see over here is that instead of the dollar strengthening, we start to see the dollar weakening instead. So now market participant now has been attuned to that. There's this potential risk of these trade tariffs may start to have a negative boomerang on the U.S. Economy. And that has been pretty much evidence on, number one, those survey-based reports like the ISM Manufacturing Report, ISM Services PMI Report. Based on that, survey respondents has a view that the cost of doing business in U.S. will start to go up, and potentially it may start to clamp down on U.S. economic growth prospect. And that actually causes the 10-year Treasury yield and the 2-year Treasury yield to actually erase its gains that was actually seen exposed U.S. presidential election. So that, in a sense, that we call it a kind of a negative boomerang impact on the U.S. dollar, but that actually indirectly benefited the Chinese stock market from here because of a weaker dollar. So it seems to us that the more hawkish Trump policy play out, the bigger risk that U.S. may slip into a recession, higher chances that the U.S. 10-year Treasury yield and 2-year Treasury yield may remain soft, and eventually potentially lead to a softer dollar instead of a stronger dollar.
And as we were talking about, previously on the show as well and off air as well, will such tariff measures, achieve Trump's aim of getting people to set up shop in the U.S. itself?
Well, I think this is pretty much too early to tell at this moment in time. But it seems to us that based on this week, TSMC actually made an announcement to actually invest more plants or building more manufacturing hub in the U.S. So we've got to see how it takes from there, because do not forget, over here, without any direct U.S. subsidies for this firm, just only tariffs, I don't think that it's able to work out economically and businessly in a business sense, because let's say take for example TSMC. So the reason why TSMC still has most of the manufacturing hub in Asia because of this clustering impact, given the fact that number one, cheaper cost of setting up the business over there in Asia and as well as locally, and as well as we call it the connectiveness of the indirect, direct supply chain or suppliers of TSMC to produce the final product, and as well as local knowledge, know-how to actually build this high-tech wafer fab manufacturing chips or manufacturing plant, how to operate that. So without any lack of subsidies from U.S., the only thing is that for the tariff threat itself, businesses, I got to see whether businesses will start to actually warm up to this idea.
Okay. You talked about no subsidies. That's our next question, which is U.S. President Donald Trump's address to Congress. And in his address, he has called for an end to a landmark $52 billion semiconductor subsidy program that spurred more than $400 billion in investments from companies like TSMC, as you mentioned, and Intel. The subsidy was signed in the Biden administration, but how far does this contradict against his talks on the Stargate project? What will this mean for U.S. tech industries? Do you expect tech stocks to respond today?
All right. So if you look at the current situation for the U.S. Tech stocks has been rather lackluster in the last 3 to 4 weeks or so. So what we could see over here is that the tech stock may continue to underperform from a longer term perspective, because do not forget over here is that the difference between Stargate and Chips X is over here is that Stargate is privately funded. Right? That means we talk about that 500 billion earmark fund. Mm-hmm. Those are co-funded by OpenAI, SoftBank, and Oracle, and in some way Microsoft and as well as NVIDIA. What U.S. government or the current White House administration will actually play a part in Stargate is to provide sufficient energy resources to generate this particular data center that's going to be built by Stargate. That means, i.e., it's more about training on this large language model that require intensive of data centers which run on energy. So that's what Trump's one over here is to actually we call it explore more energy oil in the U.S. to actually run this data center, and as well as provide more title land to actually build these data centers. So rather than providing direct subsidy from the 52 billion Chips Act itself. So the key thing over here is that market participants now have started to realize that over here is that, yes, if Stargate AI were to run successfully itself, the operational cost will be pretty much huge because there's no subsidy piece involved. The only thing that is only state land could be used, maybe energy sources will be cheaper. We do not know about that yet. But it seems to us that market participants are now warming up to alternative ideas like DeepSeek, which run a reasoning AI LLM model, which is almost on par with the current OpenAI and with the likes of other cloud-based model like Alibaba as well. In terms of operational cost, it's much cheaper. So that's because of this operational cost issue and the efficiency issue. That could actually be kind of a headwind for U.S. AI-related play to continue its prior outperformance that was seen 2 years ago.
And we have about 1.5 minutes to go, Kelvin, but I really want to pose you this one. What else should we take note of out of Trump's address to Congress today, as well as the ramifications on U.S. markets? I mean, tariffs was a huge topic. Doge was the other. Investment in the gigantic natural gas pipeline in Alaska being one as well. What stood out to you today?
Well, it seems to me that the scenario was tariffs is going to be his cornerstone of his policy. Because he mentioned about tariffs. So he claimed that tariffs will lead to more jobs to U.S., but that goes against, economic 101 model. And I would like to see how does this going to play out going forward. Because two things, it seems to be that we know that in the last couple of weeks, market does not like tariffs. Right? There's still some hope that they may actually go down to the table to negotiate with the targeted countries like Canada, Mexico, and China. But it seems that Donald Trump does not want to actually do a negotiation this time round. And he's very hawkish to push through this tariff. And he did mention that, yes, there's going to be a bit of pain involved. So what he means over here is that he seems to be ignoring market participants or I would say financial market participants' impact on the negative feedback loop that these tariffs could have on the U.S. stock market.
I suppose lots to watch indeed. Thanks so much for the insights, Kelvin. That was Kelvin Wong, Senior Analyst at OANDA. Thank you so much for joining us on Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance.